Hey everyone, I'm James. I work in Bloomberg Intelligence, which is Bloomberg's research arm. So we cover ETFs and the broader asset management industry. I'm going to fly through a bunch of slides here, so bear with me, and I'll be around afterwards if you guys have any questions. So to start, all of our research and the data, a lot of the charts that I'm going to show you today are available on the terminal on our dashboard, which is BI ETF Go. And these are some of the topics we're going to talk about today. We're going to talk about a little bit about what's gone on so far this year, the great cost migration, histrionics busting, and then a few of the things that we do to tame what's going on in the ETF market, how to analyze it. So first, a weird year. This is the first year since 2009 that fixed income ETFs were dominating flows over equity ETFs. Now, a lot of that changed early on in the summer. It's a little more even now, but fixed income ETFs have been dominating in flows, and that's been the big story so far this year. Another thing we like to talk about is the people's fear gauge, as my colleague Eric Balchunas likes to call it. Essentially what we look at here is we believe that the dollar volume on SPY is a better indicator of what fear in the market than the actual VIX. Because what happens is it's a more democratic solution. Because when you're looking at SPY, you're looking at more things that are, more people that own it. It's more democratic. There's retail investors, mom and pops, to institutions, options, futures. Everyone's kind of using this thing. And for the most part, we find that when people start tilting their portfolios from institutions to retail investors, they're tilting at the edges with things like SPY that are highly liquid and easily tradable. Another thing we like to look at, you hear all this stuff about flows going out of X or going into Y, high yield or equity, but really what you're looking at is only a handful of ETFs. So we have a list of what we consider to be ETFs dominated by trader use. And we also have a list of ETFs that are dominated by allocators or advisors. So when you're looking at this, they're really two different sets. And now, obviously, there's some ETFs that fall in the middle there, but we don't incorporate those. And what you see is that when you see these huge outflows, it's dominated by these few ETFs, like the Qs, SPY, some of the sector ETFs, these things that have been around since the 90s. They're great products, they're great for institutions, but they're not allocators really changing what they're doing for the most part. When we see changes like that, that's when we get worried. And this is what we call our Picasso chart. Basically, it says a lot of things in one chart. What we're looking at here is active funds in blue, passive funds in white, passive index funds, and orange is ETFs. And what you overlaid, we have the S&P 500 return for that year. So this is the yearly flows. And what you see is a few things. One, you see that flows are kind of dictated by what's going on in the market. So when you have a really strong market, flows tend to pick up. And what you also see is all those outflows coming out of the active management, a lot of it's offset by the inflows going into passive and ETFs. So now we're going to talk just quickly about the great cost migration. This topic has been beaten up a bit, but cheap beta is a smash hit, which everyone here probably knows. Everyone wants to own cheap beta. Somewhere around 60% of the flows in the last year have gone to things charging 10 basis points or less. If you go to 20 basis points, it's up around 90%. All the money is going to cheap. Now, if you look at this, you look at the average expense ratio of an ETF, it's around 50 basis points right now. The asset-weighted expense ratio just dipped below this summer, 20 basis points. So the average fee that people are paying in the US ETF market is under 20 basis points. And flows, as I just talked about briefly, the flow-weighted fee, or the last year where money is gone, is around 10 basis points. So we see this trend continuing. So histrionics busting. When you look at this, a lot of people have been attacking ETFs over the years. Basically, for the last decade, people have been saying things about ETFs are going to cause the next blow-up. They're distorting fundamentals. Most recently, Michael Burry called for a passive bubble related to passive index investing to CDOs, which I'll dive in a little deeper. But it's a little over-exaggerated. This is a great chart. It's a little old, but ETFs here, they say 6%. It's that little sliver of the market. Right now, it's around 7 to 8%, but still, it's much smaller than most people like to admit. And when you look at this in aggregate compared to the total equity market cap in the US, you see ETFs in blue, index funds in white, and you can see they're nothing. They're a speck on what's going on here. Theoretically, yes, a tail could be wagging the dog, but we don't see it in the data at this point. Another thing that flies in the face of this is GE is a perfect example. GE is in a ton of different ETFs and index funds. And when you look at this, all the flows that have been coming in, we're talking tens, hundreds of billions of dollars. Everyone says it's propping up these stocks. GE got crushed over the last couple of years, and everyone knows that. So there's tons of examples like this of money flying in through the passive world, and the stock price still goes down. And we also hear they haven't been tested. 2008, taper tantrum, tons of these things that have proven that ETFs have been tested. And people who say they haven't been tested haven't really looked at the data, obviously. And because they have been tested, institutions are taking notice. So what we look at here is 13Fs, or what these institutions are filing as what they're holding. And as a percentage of total 13F filings, ETFs have dramatically increased since 2008. So 2008, we were looking around 3% of 13Fs filed were in ETFs. We're around 9% now. Also here, passive investors have weak hands. These are what the flows looked like in 2008. Index mutual funds saw inflows. ETFs saw even bigger inflows. For example, Vanguard didn't see a single month of outflow during 2008. It was the active investors that traded hands. So theoretically, if those active investors are now in passive and something happens again, we could see something similar. But in 2008, that's not what happened. So now we're going to move on to legit worries. One of them is overtrading. ETFs are easy to trade, as we just talked about. And that could be bad for some investors. There's been studies out there that show people who tend to trade their portfolio a lot more tend to underperform their counterparts. And even some of these, this is a white paper that basically looked at some brokerages. And people that had their money in high-cost mutual funds with loads on the front end and back end actually outperformed people that had high turnover in their ETFs. Another legit worry, which was spoken about also on the panel, is that people are too focused on on-screen secondary liquidity. If you look at the first 15 ETFs, we always talk about how ETFs trade a ton. The first 15 ETFs make up 50% of the ETF volume on US exchanges. And it gets worse and worse as you go down. We're looking at 2,000 ETFs. Almost all of it comes in the top 100 ETFs on the exchanges. So to look into this, you have to use implied liquidity, which basically looks at what they were talking about in the panel. You look at the primary market liquidity, the underlying stocks, how much do those trade? We have a tool in Terminal that can kind of give you a gauge of how much those are trading and what the liquidity profile of the ETF actually looks like. So another area that we have been talking a lot about this year is what we're naming the beta vortex. So as everyone knows, tons of money is flowing out of active mutual funds, but it's being offset by even more money going into ETFs and index funds. And a lot of this is really just the cost migration. People are leaving the higher cost active funds and going to the lower cost. But it's not just that. We're also seeing it in smart beta and active mutual funds. The smart beta funds with the most assets are the ones that have the least factor tilts in them. They're the ones that are most watered down with beta. You can see the correlation in the S&P 500 on the right there. And the same thing is happening in the active mutual fund space. Active mutual funds, the one with the most assets, are the ones that are highestly correlated to large cap beta. So this is one area where we see it happening. Another area which is surprising to us is hedge funds are even increasing their correlations to the S&P 500 and large cap beta. You can see that over time, hedge funds in aggregate have increased, their correlation has increased. Now, obviously the tails are going to be a little wider here, but this was surprising to us when we were diving in because this is an area where we expected to see lower correlations. Now back to Burry. Burry talked about passive indexing being a CDO market, how he's going to avoid the passive bubble, and then he goes on to talk about how he likes small cap value and he's investing in small cap value to avoid that. Meanwhile, the two stocks he talked about are significantly more owned by passive funds than most other stocks in the market. So we're looking at GameStop, which is 32% passively owned, and Taylor Brands, which is Men's Warehouse, is 26% passively owned. The average stock is about 16% passively owned. So he's saying he's going to avoid the passive bubble, and then he's investing in it, because what happens is these smart beta rules-based ETFs are seeing a lot of the same things he's seeing probably. So this is just a chart that shows the passive ownership by sector, so by market cap. Real estate is the only one that's like really stands out here. It's about 26% passively owned. But the average, the Russell 3000 by market cap is owned about 17% by passive at this point. So now we're going to talk a little bit about the fall and rise of active management. So this is one of my favorite charts that I've put together. What we looked at is all active equity mutual funds and their assets and flows over time. The blue is flows, the orange is assets. What you see here is hundreds of billions of dollars flowing out of actively managed equity mutual funds, and their assets went up by $1 trillion. And what that is, it's basically, we call it the stock market's propping them up. As prices have gone up, they've increased their assets, and therefore their fees and revenues have gone up, despite tons of their customers leaving. So one way to avoid this is be a bond manager. Bond managers are not seeing the same outflows that equity managers are seeing. For whatever reason, advisors, investors just see the bond manager as being smarter or more worth their money than an equity manager. Another way is lower your fees. If you look here, you can see that a lot of the money is flowing out the high-cost 100 basis point type funds, but the things that are charging 0 to 20 bips and under 40 bips for active management, people are still paying for them. They're still going in. And this is indicative. Vanguard, for example, right now is, I think, the third largest active manager in the US, which most people don't realize. And within the next few years, if the trend continues, they'll be the largest active manager in the US. So another way is to adopt a Babe Ruth mentality. And what we're talking about here is investors seem to be going more towards this core satellite approach, right? So they're using the passive market to get their core exposure, and they're tilting on the satellite portion of their portfolio. So if you want to be an active manager, one way to do it is swing to the fences, right? To use high active share, use high conviction betting, and really differentiate yourself for why you're a value proposition. So in this case, ARK is a great example of them really just swinging for the fences and putting a lot of conviction behind their trades, and people are rewarding them by putting the satellite portion of their portfolio in their ETFs. Another one is make your investing rules-based. Smart beta has been basically sucking up the oxygen of active investing. For some reason, active ETFs really haven't caught on, and our biggest assumption is that it's because most people prefer to use smart beta because it's similar to active, but it's much cheaper and rules-based and transparent and a lot easier to understand what's going on. So we like to look at this and we call this whole thing the Terror Dome. And asset managers are just trying to get into the ETF space, the index fund space, Fidelity, for example. And what we found is this is what the institutions tend to look like when they start. And this is them 3 years after they've joined the ETF industry. It's hard out there. It's really hard to get assets. A lot of managers come in, we'll just launch an ETF, we'll charge 50 bips, and we'll see the flows that everyone else is seeing. And it's hard for them to realize that that's not happening. So one way they're trying to do this is active non-transparent ETFs. There's a couple different models out there right now. Presidian's coming out. We're pretty bearish on the prospects of active non-transparent as a group. We believe that in order for active non-transparent to work properly, it's going to have to be cannibalism. They're basically going to have to cannibalize their own assets and move them into these products to stem outflows. And they just haven't done that even in the ETF space. So we'll see. It's hard. It's really hard to accept that you're going to cut your revenues and your earnings to keep your assets. So how do we analyze this? Smart beta spectrum is the first one. Smart beta is huge. We're almost at $1 trillion in smart beta right now. And what we do is we're trying to come up with a rules-based system to analyze smart beta, right? So I talked about there's these watered-down versions and these high pure play versions. So the ones on the left in the green are mostly market cap weighted with some slight screen in the beginning. In the middle, they might tilt with different weightings but have sector bands where you can't go out of the sector bands of some sort. And on the right is the ones that are real pure factor, like really trying to invest. And the way we look at this is we look at things like number of holdings, so how concentrated is the position, what's the turnover look like, all these different things are going to go into it. But as you can see here, as I talked about, this goes back to the beta vortex. All the money's going down to the watered down stuff, the stuff that has very little exposure to what people traditionally consider to be a factor. Basically, advisors want to tell the story of investing in value or growth and all this stuff, but they don't want the different performance from the S&P 500 because they don't want to talk to their client about it. Thematic capture score. Theme ETFs are huge business right now. They are booming. We're at $50 billion in assets right now, thematic ETFs, as Bloomberg Intelligence classifies them. So what we've come up with is a thematic capture score, just another way to do your due diligence on what you're investing in. So this is an example of research we did for the rare earth metals ETF. Back when we were worried about all these tariffs potentially going on rare earths, we decided to look into what's actually under the hood. And what we do here is we look at two things. We look at active share to the most relevant sector, and we also look at revenue purity. So if you look at revenue purity and active share, you get this combined score that says how much of the theme are you actually getting and how differentiated from the traditional exposure you already have in portfolio are you getting here. So in this example, rare earths, we got 51% because very little of the revenue in those companies actually came from rare earths. But if you expand it to strategic metals or critical metals, which includes things like cobalt and lithium, you end up with a much higher score. So how pure is your theme ETF? What we look at here is basically the score is more relevant in comparison to other ETFs in a similar realm, right? So this is marijuana ETFs. We're doing the same thing with the score, but necessarily it's not the best to be the highest pure. It depends on what you're looking for. So if you talk to the guys that run Cambria, MedFob, he says the reason their score is so low is because some of the stocks that are in this marijuana pure exposure are so overpriced that he can't even find a way to get his model to value it at what he's seeing. So that's an active fund. So these are all things you have to play into and do your research on, which is another step of your due diligence process. And this is an early step that we've developed called the ETF Traffic Light. And the way we looked at it is we don't believe in, first, Bloomberg Research doesn't do buy, sell, hold. And we also don't believe that's the right way to handle the ETF ratings. Because just because an ETF, like for example, a VIX ETF, it may have terrible performance, it's probably a terrible fund to invest in, but if you're a hedge fund investor and you're looking to hedge volatility, it's perfect for what you're looking for. So we thought of movie ratings as more relevant. Just because your 5-year-old son exists doesn't mean our rated R movie shouldn't exist, and that's the way we view the ETF industry. So we were actually working on this when XIV imploded in February of 2018. And we basically rushed it out to market after we were pretty much done, but we were taking our time getting it out, and this was the perfect time to launch it. And what we do is you look at things like how is it taxed in the underlying, hidden fees. So in the tax treatment, for example, a lot of people don't realize that gold is taxed differently on the long-term investment. It's taxed as a collectible, which is a higher rate than long-term capital gains. Things like that. We look at leverage. We look at futures roll costs, things that some investors don't even realize what they're getting themselves into. For example, USO, which a lot of people were probably playing this week after what's going on in oil. A lot of people don't realize you're not buying oil, you're buying futures, and there's roll costs available to that. I've had friends that told me they bought it, and they're like, why is my ETF down 30%? So these are things we're just trying to alert investors of and stop them beforehand and just be a starting process for doing your due diligence. So what this looks like, this is on our dashboard, that BI ETF I spoke about. And basically, if you get 0 to 1 points, you're a green light in our system. If you get 2 to 4 points, you're a yellow light in our system. 5 or more, you're a red light. Most of the red lights are those leverage products that use futures and things like that. Majority of the products are in green and yellow to an extent. And we're not saying they're bad. Again, it's just things that investors should be aware of what they're getting themselves involved with. Right? All right, stop, take a second, understand what you're investing in. If you're still okay with it, go ahead and do it. So all of this stuff I talked about, all of our research is on the terminal, BI ETF Go. A lot of the data sets we've kind of customized and curated and launched them on our own dashboard that we use and some of my counterparts in news use as well. We are available off the terminal as well. So we have a TV show, ETF IQ. It's at 1 p.m. on Wednesdays, and we also have a podcast, Trillions Podcast. So we're very active on Twitter is the other thing. We get a lot of our ideas from advisors, a lot of people asking questions, and there's a huge FinTwit community where we talk a lot back and forth about what we're doing research on. And all of our stuff we put out in a newsletter every 2 weeks with links to our most read research, and we put a couple of charts that you saw up here today in there. So if you're on the terminal, even if you're not on the terminal, you can shoot me or my colleague Eric Balchunas an email, and we can get you added to the newsletter. Thank you.